Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Qualcomm.
If you find our talks useful, please consider subscribe, like, and comment underneath. Right, so before we jump into anything else, if you're looking at your portfolio right now, this specific stock really demands your attention. I mean, mostly because of the pure whiplash it just put investors through.
Oh yeah, it's been incredibly volatile.
Right. We're talking about a massive mega-cap technology company that it essentially fell off a cliff. It dropped 26% from its 2026 high.
Which is a massive haircut.
A completely massive haircut. But then, almost out of nowhere, it violently snapped back, rallying really aggressively right ahead of a major upcoming catalyst.
Yeah.
So it forces you to ask, did the market get something fundamentally wrong during that sell-off, or is this just a temporary bounce?
Well, that extreme volatility is it's actually creating a truly fascinating chart setup right now. And actually, before we unpack exactly why that snapback happened, I should mention that if you're trying to make sense of these kinds of dramatic market moves, there's a really useful chart tool for investors and traders. If you want help reading trading charts more clearly, you can check out VIP Algos through the link below in the description.
Yeah, it's super helpful.
It really is. VIP Algos is an educational TradingView indicator suite, and it features visual buy and sell chart alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas. It's incredibly helpful for scanning price action across stocks, Forex, crypto, and futures.
Just strictly for educational use, though.
Exactly, just educational. VIP Algos is an educational chart analysis tool only. It is not financial advice, it does not place trades for you, and it absolutely does not guarantee profits. Trading involves risks, so always manage your risk and do your own research. And just a heads up, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Okay, perfect. So let's unpack this stock from a wealth building perspective. Because if you are a long-term investor, you are probably looking at this and asking one core question, like how does a legacy smartphone modem maker even fit into a forward-looking portfolio today?
That's the big question, isn't it?
Yeah, because for years, their entire identity has been completely tied to being, the little chip inside your phone that connects you to a cell tower. Why would an investor hold this when they could just go buy pure hyped up AI companies?
Well, because that legacy perception is exactly the narrative they're aggressively fighting against right now. They are undergoing this profound structural transformation. They are no longer just a handset company.
Right.
They're repositioning themselves to be a diversified edge-to-cloud computing leader in artificial intelligence and automotive tech. They want to be the intelligence running your car's dashboard, the low-power inference engine processing queries in massive data centers, and, the brain inside connected industrial devices.
I hear that, but I mean, it honestly sounds a bit like a homeowner trying to completely rebuild their house's foundation while they're simultaneously throwing a dinner party in the living room.
That's a great way to put it.
Because the smartphone market is still their living room, right? That's where they actually make their money.
Yeah.
So how should you categorize this? Is it a pure growth story now? Is it a value play because they've been beaten down? Or is this just a classic turnaround?
It is a textbook JARP story.
Yep.
So growth at a reasonable price. For investors who are willing to weather the messiness of this foundation rebuild you mentioned, you're getting a company that still prints cash from its legacy operations.
Mm-hmm.
But they are systematically using that cash to fund these high-growth future markets. Yeah. You aren't paying the astronomical sky-high premiums that you see with pure-play AI high flyers, but you're still getting direct exposure to those exact same massive secular tailwinds.
Okay, so that gives us the bigger picture. But to verify this whole rebuilding the foundation story, we really need to look at the actual cash and revenue engines. Are the numbers actually backing up the narrative, or is this just corporate wishing?
Oh, the numbers absolutely back it up, but you kind of have to look under the hood to understand why. So in the first quarter of fiscal 2026, they posted staggering revenues of $12.3 billion.
Wow.
Right, followed by $10.6 billion in the second quarter. But here is where we see that structural shift actually playing out in the data. Their legacy handset revenue fell 13% year over year.
Okay, hold on.
But meanwhile, their automotive segment hit an all-time record of $1.326 billion, which is up 38% year over year.
Right, a 38% jump in automotive is huge.
Right.
But I have to stop you there and push back on that 13% legacy handset decline, because management's official explanation for that drop was, quote, Memory supply constraints.
Yeah, that's what they said.
Is that a valid excuse? Or is consumer demand for smartphones actually slipping? People are keeping their old phones longer, and management is just, like, pointing the finger at the supply chain to save face. I'm highly skeptical that the combined 20% growth in automotive and the Internet of Things is truly enough to offset the massive drag of a shrinking smartphone market.
I mean, it's entirely fair to scrutinize that excuse. But the underlying mechanics of modern smartphones kind of explain what's happening here. The new generation of AI-enabled phones requires massive amounts of incredibly fast memory to run complex tasks locally.
Right.
So if the external memory manufacturers simply cannot produce enough of those specific memory chips, you cannot build the phone, no matter how many consumers are lined up to buy one. Management has explicitly stated they are undershipping compared to actual consumer demand because of this bottleneck.
Okay, I see.
But here's the critical part. Even with that handset unit drag, their underlying profitability is incredibly durable.
How so, though? Because if fewer phones are shipping, shouldn't their cash flow be drying up?
It comes down to their QTL licensing segment. This is basically their intellectual property division. They collect royalty fees on virtually every 3G, 4G, and 5G handset sold anywhere on the planet.
Wait, regardless of whether their physical chip is inside it or not.
Exactly. Regardless of whose chip is inside, it's essentially a toll bridge for cellular technology, and that division operates at a staggering 72% margin.
A 72% margin. That is practically software territory right there.
It really is.
Well, that explains the massive cash pile, though.
Yep.
They're sitting on $9.6 billion in free cash flow over the last 12 months, with a return on equity of 36.4%. And I guess that explains why the board just authorized a massive $20 billion share repurchase program.
Yep.
You absolutely do not authorize a $20 billion buyback unless you are deeply confident in your ongoing cash generation. But having cash is one thing, right? Winning in the future is another. What about their competitive moat in this new AI landscape? How do they actually compete with the giants who already dominate the data center?
This is where their strategic moat is shifting from purely cellular patents into custom silicon. They recently acquired Alphawave Semi for $2.4 billion.
Why? I saw that.
Yeah, that acquisition brought in critical, high-speed wired connectivity technology, which immediately positioned them as a credible third supplier for custom data center chips, putting them right alongside heavyweights like Broadcom and Marvell. But the real game changer here, the piece that could shift the entire industry, is their new AI 200 and AI 250 accelerator cards.
Okay, let's break that down for the listener. What makes these specific accelerator cards so special compared to the hardware that's already powering AI out there?
It is all about memory capacity and power efficiency. These cards feature an incredible 768 gigabytes of memory.
Wow.
Yeah. To understand why that matters, you have to look at how AI operates. When you ask an AI a question, which is called inference, the processor needs to access the large language model. If the model is too big to fit on the card's memory, the processor constantly has to fetch data from outside sources.
Which slows everything down.
Exactly. It causes latency and burns a massive amount of electricity. Because these new cards have so much onboard memory, you can fit an entire massive AI model directly onto a single card.
Okay, here's where it gets really interesting. I love a good analogy for this. So, think of a standard massive GPU used for training AI, like a giant gas-guzzling freight truck.
Okay, I like that.
Right. It's incredibly powerful, and you need it to haul massive loads of data when you are building the AI from scratch. But if you just need to deliver a single pizza, which is essentially what inference is, just running a basic user prompt, you don't fire up a freight truck.
Yeah.
You use a highly efficient moped. They're essentially building the ultimate low-power moped for the data center.
That is the perfect way to visualize it. It creates a massive advantage in total cost of ownership, or TCO. Data centers are currently constrained by the limits of their local power grids. These cards use a fraction of the power of traditional power-hungry GPUs.
Makes sense.
So for hyperscalers, the massive cloud providers running these data centers, this creates a structural switching incentive based almost entirely on saving electricity and cooling costs.
That makes total sense. Electricity is literally the ultimate bottleneck right now. So if the fundamentals are shifting this significantly and they have this incredible new hardware, why isn't the market rewarding them yet? What are the upcoming catalysts that will force the broader market to wake up and actually reprice the stock?
The single most important event on the horizon is the June 24th Data Center and Physical AI Investor Day. That date is circled on every institutional calendar right now.
Definitely.
Following that, we have the third quarter fiscal 2026 earnings in late July. Management has strongly signaled that they expect the handset memory supply squeeze to finally bottom out in that quarter. On top of these company-specific events, there are broader macro tailwinds.
Like the rate relief, right?
Exactly. The recent momentum around the Iran peace deal has provided some macroeconomic rate relief. When interest rates look like they might ease, we typically see capital flows rotate back into long-duration technology and semiconductor stocks.
So let me challenge that June 24th Investor Day hype for a second. Is this just going to be another slick corporate presentation with, a bunch of vague, optimistic projections for the year 2030? Or are we going to see actual receipts?
That's the million-dollar question.
Because there have been rumors swirling about a, quote, leading hyperscaler custom silicon engagement. But if everyone is already whispering about it, isn't that good news already priced into the stock?
That is the exact tension driving the market right now. The market demands absolute proof that this data center pivot is a quantifiable, revenue-generating business today, not just a futuristic slide deck.
Right.
To impress the street, they need to walk out on stage, name specific hyperscaler customers, and provide a quantified, hard revenue ramp for fiscal 2027. If they can deliver actual receipts and name names, it is absolutely not fully priced in yet.
Okay, so the catalysts tell us what could potentially change the fundamental story. But let's look at how the price is actually reacting on the chart, because that tells us what institutional money is really doing behind the scenes.
And the price structure here is a textbook example of a washout and reversal. Remember that volatility we mentioned at the start?
Yeah, the 26% drop.
Well, specifically on June 1st, the stock shed 9% in a single day. That was a direct, fear-based reaction to NVIDIA's Computex announcements. The market got spooked, assuming dominant GPUs were going to eat every corner of the computing market. But then, on June 12th, the stock aggressively rallied 4.8% to close right near the $228 to $229 level.
That is fascinating, because that looks exactly like weak hands got completely shaken out by the NVIDIA headlines, but massive institutional buyers were sitting right there at that support zone, just waiting to scoop up discounted shares and effectively creating a hard floor. It really highlights the importance of being able to read those support and resistance zones, like we talked about earlier. When you see a 9% drop instantly bought back up over a few days, that is coiled momentum. So what do the valuation multiples look like in the context of that chart structure?
That valuation is exactly why those buyers stepped in. There is a massive value growth re-rating underway. Even with that aggressive rally, the stock is still trading at roughly a 21.9 times forward earnings multiple.
Which is pretty low.
In the broader high-flying semiconductor space, that is a steep discount. But more importantly, it has a highly attractive PEG ratio of 0.75.
Let's explain the PEG ratio briefly for anyone who hasn't used it in their portfolio analysis. It stands for price to earnings to growth. It basically asks, how much of a premium are you paying for a company's future earnings growth? A rule of thumb is that a PEG ratio exactly at 1.0 is fairly valued, so it's 0.75.
Exactly. At 0.75, factoring in their 23.5% expected earnings growth, the stock is essentially on sale relative to how fast it is expanding. You are getting high-end growth at a deep discount.
So the chart shows institutional support, and the valuation makes sense. But what does market sentiment look like? Is the news flow and analyst commentary actually aligning with this bullish setup?
The sentiment is overwhelmingly bullish right now, and it is backed by tangible, real-world deals. They just secured a massive agreement with ByteDance to supply millions of ASICs for AI inference.
Quick definition there for the listeners. An ASIC is an application-specific integrated circuit. Unlike a general-purpose chip, an ASIC is custom designed to do one highly specific task incredibly efficiently, which in this case is running AI queries.
Right, exactly. And on top of the ByteDance deal, they have a 200-megawatt deployment with Saudi Arabia's Humane Initiative, and they just announced a major collaboration with SLB to deploy Edge AI in the energy sector.
Edge AI in energy makes total sense. Think about it. If you were out on an oil rig in the ocean or monitoring a remote pipeline in the desert, you don't have a massive power grid.
Nope.
You also don't have the high-speed fiber optic internet required to send massive amounts of data back to a central cloud server. You need the intelligence right there, locally, at the edge, and it has to run on minimal power. That is their exact specialty. But with all these deals piling up, Are the analysts getting a bit ahead of themselves?
The analyst actions certainly reflect a massive shift in expectations. We've seen a flurry of recent price target hikes. Wells Fargo just raised their target to $230.
Okay.
JP Morgan bumped theirs all the way to $260, specifically citing their belief that this new data center revenue could exceed $3 billion by fiscal 2027. And 2047 Walsent went even further, issuing a massive price target of $300.25.
That is a massive range of targets. But I have to ask, is this Peter Lynch jar ARP label just a convenient way for Wall Street institutions to justify chasing AI momentum? When everyone starts pointing at the exact same valuation metrics to justify raising targets simultaneously, you always have to wonder if the optimism is creating a blind spot.
That is a very valid concern. And while the sentiment picture is incredibly useful, we absolutely must balance this excitement by putting the downside risks front and center.
Yes, let's lay out the explicit bear case. What could derail this entirely?
The most glaring structural risk hanging over this company is the Apple modem situation. It is no secret that Apple is aggressively building its own internal modems to completely phase out their reliance on outside vendors.
Right, they want to do it all in-house.
Yeah, exactly. That phase out runs through 2027. This isn't a possibility. It represents a guaranteed structural decline in their legacy revenue. When you combine that guaranteed loss with their heavy concentration vulnerability in the broader handset market, which, as we discussed, already dropped 13% recently, there is a very real existential threat to their baseline cash flow.
And we have to heavily scrutinize the NVIDIA risk, too. We just talked about how the stock dropped 9% simply because NVIDIA gave a presentation. NVIDIA just launched their RTX Spark superchip specifically designed for AI PCs.
Yeah, that was a big announcement.
On top of that, Microsoft is easing the exclusivity window for their Copilot Plus PCs, which originally favored this stock's specific architecture. If NVIDIA is the 800-pound gorilla that dominates the brute force data center market, and now they are aggressively moving into personal computers, won't they just eventually crush them in laptops too?
It is the elephant in the room. But we have to forcefully distinguish between power-hungry GPU training and power-efficient edge inference. You simply do not need an incredibly expensive, massively power-hungry GPU to run a simple text generation query on a laptop, or to manage a repetitive, low-level task in a data center.
Overkill.
Complete overkill. Hyperscalers are eagerly looking at this alternative architecture precisely because it allows them to save up to 65% on computing costs for everyday inference. They are carving out a distinct, highly profitable niche where traditional GPUs are simply overkill, too hot, and entirely too expensive to operate.
Okay, so we've looked at the massive cash generation, the shift to AI hardware, the upcoming June catalyst, and the very real risks with Apple and NVIDIA. With everything laid out on the table, what is the final verdict?
Based on all the underlying research and fundamentals, we arrive at a bullish score of 8 out of 10.
8 out of 10, okay.
However, the final stance here requires looking at a dual time frame. On one hand, you have a very compelling short-term swing trade setup heading directly into that June 24th Investor Day, where quantified data center guidance could act as a massive, immediate catalyst. But ultimately, for wealth building, this is a multi-year hold time frame, think 12 to 18 months.
Right.
You hold this while the automotive segment hits its projected $6 billion run rate, and while those custom AI inference chips actually start shipping at scale to data centers, they offer a highly asymmetric gyre profile that the broader market simply has not yet fully digested.
And of course, we always have to remind you that this discussion is for educational purposes only. This does not constitute financial advice to buy, sell, or hold any security. And if you want a cleaner way to read trading charts and identify the support zones we talked about today, check out VIP Algos through the link below in the description.
Yeah, definitely check it out.
VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make charts much easier to scan, but it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk accordingly. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
Before we go, just think about that house foundation metaphor one last time. If they manage to successfully swap out the old, crumbling smartphone bricks for new, high-growth AI and automotive steel without the roof caving in during the process, what does that incredible structure look like 5 years from now? Something to think about.